Oh, hi everyone, it's Susie from Esoteric Trading Solutions. I hope you're all well, looking after yourself, being kind to yourself, particularly in this market that we're seeing such volatility. Please be kind to your animals, your pussycats, and just try and be kind to people in the world regardless of what's happening. It's very much the madness of the markets that I've never seen anything like it. I've got to be honest with you. Been in the markets for a long time, since 37 years, and even other people are saying the same thing. We've never seen volatility excuse me, like this. I'm actually back in Australia, and it's been really warm here, but now I'm a bit cold, so I've got my dressing gown on, and it's about 9:47 in the morning, so I hope I'm not too croaky. I find it hard to wake up sometimes, but I tell you, looking at this market, it's certainly woken me up. The Dow was down over 2,000 points last night. According to this 12.1109, it got to, it was down 2,444 points, down 10.4%. The largest drop since 1987, when I was trading markets in October 1987, and I thought my career was over. But it's just incredible. You can see it right across the board. Treasury yields, the main treasury yields that are actually traded were all down lower, but if you look at treasury yields, there were the normal, not the normal treasury yields, but the off the line treasury yields. Some of those actually went up, which is interesting, and we're actually starting to see a lack of liquidity in off the run treasury yields as well, particularly in that 30-year area. Also, banks are stopping people from refinancing that 30-year area, which I thought was interesting as well. So a lot of people want to refinance their loans, and we're seeing banks are stopping to do that as well because they're getting a massive refinancing, something like 75%. But it was a pretty incredible day, I have to say. As you know, President Trump banned travel, banned all foreigners from Europe for the next 30 days, and basically investor sentiment overall is very, very negative. We did see this continued sell-off in the equity markets and risk assets, quite dramatic, I have to say. Even with the Fed coming in and putting 1.5 trillion of liquidity into the market, it still didn't do a lot. They're putting money into, obviously, the market, into the repo market and everything else. It still didn't do a lot to bump up these markets. We did see a short covering rally, and then the market got completely sold again. We are seeing hoarding everywhere globally. People here are buying toilet paper and food stocks and everything else, and even Woolies here, which is one of our major grocery centres, has actually put a stop on how many quotas of toilet paper you can actually take out. I know it sounds crazy, but that's what people are hoarding, is rice, toilet paper, pasta, cans of food and that sort of thing. So the European Central Bank also announced drastic liquidity measures to support the economy. But again, investors were very disappointed that they didn't change excuse me, the interest rates like we've seen in America, and we've seen in Canada, and we've seen in Australia. So there was no change in interest rates in the ECB, which was considered quite disappointing by the investors. We did see all currencies quite volatile. The Aussie dropped to a low level, but we'll cover all that. Clearly, it's because of the scare of the coronavirus. It keeps continuing. The figures don't seem to be getting any better. Pretty much, we've seen, Italy surpassed 10,000 and something like about 7% deaths. We're even seeing in Iran, it's getting close to about 9,500 with about 4% deaths. So, and certainly in the Netherlands, the coronavirus actually increased from about 49 people to about 500. So that's a bit scary in itself. So I know I was talking about black swans, about a month ago, and I certainly didn't expect the market to come off as heavily as it did like this. I mean, the Dow's been down probably about 20% in the last week or so, and we're seeing it with all major indices as well. So if you look at the NASDAQ, that's down 10% overnight. The S&P was down nearly 10%. The Dow was down 10%. The Russell 2000, which is a wider index, was down 11%. The volatility index is up to 73.27. Now that volatility index, the CBOE volatility index, is sort of around 10 to 15 and wasn't doing much, but that's a massive move up. And it's pretty much right across the board when we look at all stocks. It's in utilities, consumer discretionaries, industrials, energy, right through the board. If we look at world equity markets, there wouldn't be too much different, I wouldn't imagine. every equity market in the world would have sold off. And it's just a question of how much different markets did sell off. The Nasdaq Composite was down nearly 10%, as I said. S&P 9.9, the Hang Seng was down 0.63. But even when the virus originated from China, it's only down about 1.3 and 0.94, which is surprising. Nikkei was down 2.27. Australian market always gets hit heavily. US gets a cold and we get pneumonia, down 3.44. And it's just right across the board. So if we look at month to date, pretty much S&P's down about 26%, Dow's down about 27%. Doesn't paint a very good picture. The FTSE's down 21, CAC down 23. The question is, when will this stop? When will this cease? I'd probably say with the Dow, excuse me, I'm a bit croaky this morning, with the Dow below 20,000, I think it should see some support there. But again, if you're going to buy anything, just buy in small and have, buy in small and just have some wide stops so that, you don't lose too much money, because this market is so whippy and so volatile that you're getting incredible ranges, literally, 2,500 point ranges, which I've never seen before in my whole life. If you look at the exchange traded funds, they're not doing as well either. They're quite down. They're down quite a lot. If we look at month to date, they're down 16%, 20% Mexico, Argentina 23%, Canada down 26%, Colombia 32%. All the emerging market countries would be down quite a lot. Brazil is down 35%. And just go through those stats. So not very good at all. If you look at the sectors, pretty much most sectors have been heavily hit year to date, but probably the most have been hit is materials at 29%, industrials 28%, financials 33%, and energy a whopping 50%. Wow, that's massive. Regional banks are down 41%. I mean, some of these have just come off so quickly. Seriously, it just shows you. We have an old saying in markets, up the stairs but down the elevator, and seriously, this is so true. Up the stairs and down the elevator, it's just come down, crashing down. Oil and gas, E&P is down 65%, massive moves, and we've seen that with the oil price coming down as well. So not great. All different sectors are getting hit pretty much. High yield is down about 8%, value is down about 10%, small caps down 20%, hedge funds down 7%, private equity 8%, buybacks 11%, IPOs 12%, just right across the board. Large cap 5%, mid cap 11%, small cap always gets hit harder, 14%. So if we go through, just keep going through, let's have a look at fixed income. And we'll see with on-the-run treasuries yields are still going down, but they've, I did do some reading that some of the off-the-market treasuries are basically suffering a lot of illiquidity, and there's reasons for that. There's not as many market players in the market that there was in 2008, and also compliance these days. Banks used to have larger balance sheets and be able to hold a lot more inventory, and these days they can't hold as much inventory. So even in the treasury market, which the off the line, if you want to call it that, off the line treasuries, which are not the ones that get issued, in recent times, even those, which is a $15 trillion market, basically is suffering illiquidity, and that's a real problem. If your underlying benchmark is suffering illiquidity off the line treasuries, then that's going to have implications for the pricing of every other market as well. So it's not a great story at all. We still see yield curves coming down quite substantially, right across the board. In Australia, the yield curve is actually steepening, so the 1 year is coming down quite a lot more than, say, the 20-year, for example, or the 30-year. So we see a steepening in that yield curve, which implies there might be another easing in Australia. If we go to Brazil, we're also seeing a steepening. They're buying the two-year rate, but selling the 10-year rate. So that's a steepening there as well. If we go to Canada, again, we've got a steepening of the yield curve. It's come down on the 1 year at 104 basis points, or just over 1%, and the 30-year has only come down 39. So risk off, or people that are putting on risk-averse positions are actually sitting in the very short end of the yield curve for countries like Australia, obviously, Canada, even the Brazilians. I couldn't imagine anyone buying Brazilian debt, that's for sure, because generally when risk is off, people don't buy Brazilian emerging market debt or even Brazilian government debt per se. If we look at China, we've sort of the same story, steepening of the yield curve by the looks of it. Wait a minute, sorry, this is the wrong way around. No, we've got a flattening of the yield curve. So here, 3 years only gone down 5.5, and the 10 years gone down 23.5. So that's actually a flattening of the yield curve. If we look at Colombian debt, that's at 142 basis points, 144. So that's emerging market debt. People won't buy it, so the spreads are actually moving out. You'll see that generally Scandinavian countries do quite well in these sort of environments because it's risk off, and their currency does pretty well, being a risk off currency like the Japanese yen. If we look at France, for example, here we've actually got a flattening of the yield curve. Okay, so they're only buying the 5 years at 8.7 down, but the longer end's down 38 points, which is a flattening of the yield curve, which is interesting. We've got the same thing in Germany as well, another flattening of the yield curve. So obviously they're calling a lot of recession in Europe simply because the ECB didn't actually cut rates either, and there's not a lot of growth in Europe at the moment, so it looks quite bad. Also with the travel bans by President Trump, so it's not great. If we look at the Greece curve, and interest rates are important to look at the moment because don't forget Greece has got all that massive debt. Their long end's going up 22 basis points, but the short end's come down 1.9. Okay, now that's the steepening of the yield curve. As that long end goes up higher in yield, it's going to be harder for Greece to repay back their debt. Okay, and it's also a reflection that the ECB didn't cut rates last night, and also Greece has a lot of problem paying back all its loans from the ECB. Plus there's austerity there. Greece's economy is just looking terrible even before coronavirus. And I'd imagine that will start, the long end of the yield curve will start steepening quite quickly, which means that the 20-year bond rate in Greece, or the shorter ones, will start selling off a lot faster than the real short ones, which are tagged cash. Okay, so in other words, if Greece has 1 or 3 year or 4 year debt, that should hold up okay short term, but the long end's going to really blow out. If we look at just going through, if we look at India. Could be also deemed as an emerging market debt, really. It's not a place I'd want to hold debt, to be perfectly honest with you. But, you know, we are slightly seeing a steepening of the yield curve there, but not dramatically, okay? But in Indonesia, which is considered emerging market debt, we have steepening of the yield curve. In other words, they're sitting in the very short end, the 1 year, 3 year and 30 years. But then, that's interesting, the 30 years actually down 4. But then 5, 20 and 10 have sold off, 15 to 38 points. And the reason why they could be seeing that 30 years is because there's more liquidity in that line of stock compared to, say, 5 year, 20 and 10. But the shape of the yield curve gives you an idea of what investors are thinking as well. Now, Italy, again, like Greece, has an enormous amount of debt. And, Italy's closed down a lot of things, schools, corporates, factories, events, because of this coronavirus, which is getting out of hand. They've got well over 10,000 people that have got it, and there's something like a 6 or 7% death rate, which is higher than SARS, which was about, in 2004, SARS was about 3%. So it doesn't surprise me Italy's yield curve is going up in yield, down in price, which is different to what the US is doing, what the Australian yield curve is doing, which is down in yields, up in price. So Italy's yields are going up. We've seen this 50 basis points, which is a lot in interest rate land, absolutely. 45 basis points for the 2 year, and then the 30 year is 7.9 or 16. So that's moving up quite substantially. Okay, so it looks like there's a tightening of cash in Italy as well, which is a bit scary, because if there's a tightening of cash, the banks could actually fall over, and that's going to cause a contagion effect. And I think that's what the European Central Bank should be worried about, to be perfectly honest with you. In my mind, they should have eased last night, and I don't understand why they didn't. Pretty lackluster, and it didn't make a lot of sense to me. If we look at Japan, again, basically people are buying Japanese yen bonds, and that doesn't surprise because they normally buy the yen as well when it's risk off. They go into the yen vis-a-vis any other currency. So Japan's interest rates all came down. And just quickly going through, and the interest rate curve gives us an idea of exactly what the market's thinking. Generally, the interest rate guys and girls are probably a lot more clever and a lot more technical than the equity people. And that's pretty much what we're seeing. You really do you see it quick, very fast in bond curves particularly. If you look at Portugal, 1 year rate through to 10 years is blowing out, and then the long run's coming in. So it sort of tells you there's a shortage of cash because these short-term rates are really pushing up quite dramatically. Now, Portugal's got a debt problem as well. It's got a massive unemployment problem, and its GDP, gross domestic product, is very poor as well. And it was very poor before the coronavirus. So not a great story, okay? Not a great story. Also, Russia's seen as an emerging market country as well. And you've got rates, rising quite substantially, okay? They're big moves. For interest rates to be moving over 1% a night, that is a massive move, particularly on a low base, okay? If you look at that on a percentage basis, that's huge, absolutely huge. And what that means, if Russia or Portugal or Spain or Italy want to finance, their budget deficits, if they want to borrow money for the rest of the world is going to ask them for more interest, for more rate of return, okay? More interest rate. It's going to cost them more to borrow. So rather than, say, a month ago, Italy, or say 2 months ago, Italy could have borrowed at 5%. Now it's going to cost them more like 2.5%, okay? So it means their interest repayments are going to be a lot higher, and it's going to be a lot harder for them to pay back the principal as well as the interest rate repayment, okay? And as you'd expect, South Africa is considered an emerging market debt country as well, and we've got the same story, okay? 5 years up, 30 years up in yield, 20 and 10, okay? South Korea is not, so yields are actually going down, and it's a steepening of the yield curve, okay? Spain, again, got the same story. Spain's got a massive debt problem, very bad GDP, gross domestic product. They've got a very bad immigration problem as well, and with a fairly, my understanding is a fairly leftist wing government as well, so it's not a great story there either. United Kingdom, we had a steepening in yield curves, and as you'd expect, the US has had a steepening in yield curves as well. So that tells us a lot about what's going on in fixed interest land. If we go to corporate debt, we are seeing that corporate debt is selling off quite dramatically, okay? And also we're starting to see it. We're seeing it in high yield debt as well, and we're seeing it pretty much across most of the different credit ratings, okay? Before we only saw it in the double B or the triple C, but now we're starting to see corporate debt sell off amongst all the credit ratings, okay? And that's another thing, that's risk off as well. So we have a look at just the high yield stuff. Double B I should say, high yield overall, which is not great, it's down 7.3. Triple C high yield is down 12%. Emerging market spreads are also down anywhere from about 9.9% through to about 5%. So we're looking at a sell-off in high yield debt as well, and that's what we'd pretty much expect, okay? Even in higher yields, we're starting to see sell-offs as well, okay? And that's pretty much what you expect when you see risk assets doing what they're doing. So if we look at particular assets, if we look at treasuries and we look at tips and we look at mortgage-backed securities, generally on the line US treasuries are doing okay, but some of the off the line US treasuries aren't doing so well, and we're seeing illiquidity. Tips are down 3.93%. Agencies are still doing okay, but Ginnie Mac, the municipals, mortgage-backed securities and more municipals are doing quite negatively. Senior loans are off 10%. Wow. High yield corp off 11.57%. High grade corp off 9.6%. High grade floating corp, floating rate notes off 9.52%. Convertibles off 23%. Wow. Also preferred stock is off 17%. Gee whiz. USD emerging markets off 15% and local emerging markets off 13%. Massive decline here, seriously. Massive. Unbelievable. I'm quite shocked by some of these declines, particularly with the convertibles as well. Amazing. Okay, let's just have a quick squeeze at currency. And we know we saw a lot of volatility in currency last night as well. The Aussie got down to, broke 62, I think, on the way down. It's rallied back up to 62.83. But again, keep an eye on US yen. As this market keeps selling down, I think there's a real risk that US yen could go through 100 to the yen. Absolutely. Not good. Now the euro is starting to come off against the US as well. It doesn't look great. I think the euro is going to be in a weak spot going forward. And I have heard rumours that, really the euro has been an absolute disaster. Seriously, it's been a disaster for countries like Greece, like Italy, like Spain, like Portugal. All the small items that used to cost, say, 1 Greek drachma all went up to $1. So the euro was a disaster for those countries, and an absolute benefit for Germany. They got the devaluation in their currency when they went into the euro. And honestly, I have heard around the traps, but a lot of countries want to go back to their own currency. I think the European Central Bank, doesn't know what they're doing. That's my view. They're lame. They have no idea. They've always been behind the curve. It's just an institution where people get paid a lot of money, and seriously, I think the euro, the one currency, has been a complete disaster, and there's pushback in terms of immigration and everything else, and you can see that with Poland particularly. Like I said, Norwegian krona and Swiss franc do well in these sort of environments, but anything else that's risk off doesn't. Again, we've got some of the declines in some of the other currencies there, but it hasn't been a great story overall, and we have seen a lot of volatility in currencies. And as we see the US equity market coming off, I said this before, we'll see US dollar coming off as well. So we've got gold did overnight. Let's just have a quick squeeze. Gold. So what have we got there? Gold 1576. Interestingly enough, gold got to about 1680, 1700 US. I'm surprised it came down overnight, but I'm still quite bullish on gold. I think providing it stays above 1500 US, it's going to go higher. I'd rather be in gold than silver, to be honest with you. I think gold's got a lot more opportunity to go higher. I'm surprised that agriculture is going down, because there's been such a dramatic such a dramatic food hoarding because of this coronavirus. So it surprises me that commodities are going down, and soft commodities. I'm not surprised about hard commodities going down, because industrial production figures of all the economies are going down because of the coronavirus. But it does surprise me that food commodities, agricultural commodities like corn, soybeans, and that sort of thing are actually going down, and that may turn around going forward. Gas has come down quite a bit, as well as crude oil. We've seen crude oil come down about 37% in the last month. In the last 3 months, down 47%. So massive decline, and that's just a reflection of slower growth in the whole world because of corona, particularly, and the airlines. I've got a friend that works in the US, went over there to be a pilot, and literally every airport is just empty, and he's like twiddling his thumbs, wondering what's going to happen. It seems like people will be put off with this whole corona environment, unfortunately. And don't forget, people aren't earning any money if they have to stay home, so it's going to have a real effect on consumer spend and everything else. Now, one thing I do look at is the Baltic Dry Index, which is a shipping indicator, and that has been looking negative for quite some time. 3 months before the coronavirus, it was down 56.78%, which is not a great story at all. And another one I look at is the CRB Index, which is Commodity Research Bureau Index, and that's been showing a lot of weakness, even year to date. So it's not a great story when we look at things, and I'm just wondering how long this is going to go, because it's really going to start, as I said before, cutting into growth figures globally, and there's just no way known. With the forecast, the International Monetary Fund was talking about 2% for world growth. It's just not going to happen. As a matter of fact, you're probably going to see world growth at about 1.5%. If we also start seeing higher unemployment because of this virus, you're going to see more non-performing loans on balance sheets for banks, and also you might even see the banks starting to have a liquidity run as well because of a lack of cash, and there might be also via the banks a liquidity problem as well, so credit starts to tighten. And we've certainly seen that within the money market system itself, with the US with the repo rate, and also with the off-the-line treasury curve, which is a bit of a concern, I have to say. So it's not a good story at the moment, and and we'll have a look at I don't know whether I want to look at cryptocurrencies. They've been absolutely smashed, seriously, and technically speaking, cryptocurrencies shouldn't be falling with other markets, but they are, because there's as I said, there's a link between all markets, and that's cash. And when one market goes down, they sell everything. But I don't even think I want to look at cryptocurrencies at the moment, to be perfectly honest with you. It's all too depressing. But let me look at some of the stories. It won't be a sec. So let's have a look at the news of the day. The Federal Reserve said it would pump trillions of dollars into the financial system in a dramatic response to signs of stress in short-term funding and US Treasury markets. The central bank said it is also making changes to a program of Treasury purchase to foster smooth Treasury market functioning. So for the third time in 4 days, the Fed's New York arm announced on Thursday that it would increase the size of its lending in the repo market, where investors borrow cash in exchange for high-quality collateral like treasuries, this time by multiples of the amounts previously on offer. So they offered $500 billion in 3 months loans, beginning immediately with another $500 billion of 3-month loans on Fridays. It said it would provide a $500 billion 1-month loan on Friday that settles in the same day. So the market originally bounced on this news, but then came back quite a bit on this news. So if we look at just other news, just some of the main headlines, the top stories: global markets panic grips financial market after US travel curbs. Norwegian Air axes up to 50% of employees as coronavirus layoffs begin. Disney closes due to coronavirus. It's amazing just how how much this has spread. It's in now 118 countries in the world, compared to SARS in 2004, which it only was in 29 countries. So and the thing is, there's some belief that the figures that China have been reporting aren't quite correct, with about 80 million people that are confined to their homes and that sort of thing. So if we look at the latest more news, just the latest news. What else we got here? Fed pumps trend in the financial systems, as we said. All the same doom and gloom, unfortunately. But I wonder whether there is a time to start buying in the US stock market. I'm not really sure at the moment. I'd like to see some sort of consolidation, that's for sure, rather than prices just continually going down. What else we got? Bulgaria declares state of emergency over coronavirus, and how much is this going to fall by? It's a question. I mean, I would have thought 20,000 on the Dow would have seen some sort of consolidation. That's my view at the moment. I know it's very hard when you're trading markets and you've got investment portfolios, guys, so I think everyone's in the same boat. It's not a great story, that's for sure. What else we got here? Saudi giant announced it will increase oil production to record levels. UK supermarkets start rationing as panic buying strips shelves bare. We're starting to see that in Australia as well. They're now putting in a quota system to how much you can buy. Just seems unbelievable. When there's things like this, people really do panic, that's for sure. If we go to just the coronavirus page and just have a quick look at that. So let's just have a look at this. This is the reference that I used for the coronavirus, and according to this, it's 128,343 confirmed, 4,720 deaths, and 68,000 odd recovered. And this is the Chinese line here, which is sort of plateauing, and the total recovered is going up, and this is the rest of the world here. So whether you believe these figures in terms of China, it's really up to you. I particularly think they're probably a little bit low when you compare them to other countries in the world. Italy's the second worst, and for some reason Italy has a lot of old people and they're being very quickly affected by coronavirus. So there's a lot of shutdown in Italy, and it's in areas such as Lombardo, up near Milan somewhere, which I'm not very familiar with. Also Iran, the figures in Iran yesterday were 9,000, they're now 10,000 odd. So they've got 429 deaths, and Italy's got 827, which is around 6% and 4%. So it is getting a little bit on the high side. Korea is the second. Then you've got Korea, then you've got France, Spain, Germany, the US, cruise ship, Japan, obviously, Sweden. The Netherlands went up quite a bit overnight yesterday, so that was quite surprising. The UK, It is, according to it's 116 countries in the world, and as I said before, that's very different to the SARS virus, which was in 29 countries in the world in 2004, and also that was created by, allegedly created coming out of China as well, in terms of eating wild animals that you shouldn't be eating, allegedly, and the same with the coronavirus now, but apparently so. But anyway, look, I guess the thing is, it's just the equity market and all risk markets, like the Bitcoin, current cryptocurrency market, they're all risk trades at the moment. But I guess we just have to see where all this goes at this stage. It is something very new to all of us. We don't know how or when this is going to finish. It's probably going to stay here longer than we all thought. So please do trade safe. Please do look after yourself. Don't take on too many big positions, because markets are really, really whippy and you'll just get stopped out. Look after yourselves. I know it's hard. We're all feeling a bit miserable because we're all losing money, myself included. But I guess this is the risk that we enter when we trade or invest in risk markets. So do look after yourself, please, and look after your beautiful cats, your beautiful animals, your parents, your family, your friends, and even just strangers in the world, just to try and make this a better place, even though at the moment it is quite difficult. Thanks, guys and girls, for listening. Thank you very much, Susie, and I'll talk to you very soon. Thank you. Let me just put this thing off. We always have trouble with putting this off. Thanks, guys.